Hi, welcome back to Joe Blogs. In today's episode, I want to provide you with an update as to what's happening in the UK economy. And if you're wondering why I'm posting so many videos about the UK, it's because there's a lot of data coming out and all of it is really negative. The UK retail sales figures have now been published for December, which is the key trading period because it covers the Christmas period, and unexpectedly there was a fall in retail sales. And in addition to that, we've now seen the GDP figures published for November, and they've also come in at a disappointing level. And all of this is really bad news because the pound is now falling again in terms of the exchange rate markets, and UK bonds are also under pressure, as are the UK stock markets. This chart shows the month-on-month movement in UK retail sales over the past 12 months, and the scale on the right-hand side of this chart goes from 5% positive at the top to minus 3% at the bottom. And what you can see on the right-hand side of this chart is that the figure for December was a fall of 0.3%. And that was a surprise for the markets, which were expecting a rise of around 0.3%. And this represents continued bad news for the UK because you can see that in September, retail sales fell by 0.2%. There was an acceleration in the fall in October to 0.8%. There was a slight recovery in November when retail sales grew by 0.1%. And the fall in December means that retail sales have fallen in 3 out of the last 4 months. And these 4 months are absolutely critical to UK retailers because they cover the key Christmas trading period. So those figures paint a fairly bleak picture. But actually the situation is significantly worse than that because those retail figures that you've just looked at actually include fuel sales. And if you exclude fuel sales to look at what the genuine retail sales were, they're actually significantly worse. This chart shows the month-on-month movement in retail sales excluding fuel sales. And what you can see here is exactly the same trend that we've just seen for retail sales. However, the figures are much worse. In September, there was a fall of 0.1%. That fall accelerated to 1.1% in October. There was a minor bounce back of 0.1% in November. And in December, retail sales excluding fuel fell by 0.6%, which is double the fall that we've just talked about for retail sales. And the reason why retail sales are so important in the UK is because the UK is now a net importer. It's paying more for all of its imports than it's receiving for all of its export sales. And so the UK needs its own economy to be growing in order to boost its GDP. This chart shows the month-on-month movement in GDP in the UK, and the figure for November has just been released and shows that GDP grew by 0.1%. However, unfortunately, that was half of the 0.2% that the market was expecting the UK to achieve. And when you look at what's been happening over the past 8 months, you can see that GDP has fallen in 5 of those months. And the disappointing result in November is now raising the question as to whether or not the UK will see a contraction in its quarterly GDP for the final quarter of 2024. And if we look at this chart, which shows both the month-on-month movement in GDP shown by the bar charts and also the quarter-on-quarter movements, which are shown by the line chart, you can see why there are concerns right now. If we focus in on that quarterly movement shown by the line chart, you can see that in the first half of 2022, there was a significant downward trend in quarterly GDP. There was a slight bounce back at the second half of 2022. However, 2023 was a bad year for the UK. Quarterly GDP was on a significant downward trend. There was a bounce back at the start of 2024 when we started to see some recovery. That recovery flatlined and then fell. And in the last quarter, we have seen 0% growth. And that's why there are concerns right now and worries about what's going on in the UK economy and if it could go into recession in 2025. This chart shows the movement in the exchange rate between the British pound and the US dollar over the past 12 months. And what you can see here is that the current exchange rate for the pound is the lowest that it's traded at any point in the last 12 months. And the reason why the pound is trading at such a low level is a combination of the lack of growth in the economy and levels of debt that the UK government are taking on to fund all of their spending plans. And if we expand the scale of this chart to show the situation over the past 25 years, you can see that the current level that the pound is trading at is one of the lowest rates, and in fact the only time in the last 25 years when the pound has traded at a significantly lower level was when Liz Truss was appointed as Prime Minister, and as we've discussed in previous videos, that only lasted for 49 days. This chart looks at the expected volatility of the UK pound dating back to 2016. What you can see here are huge spikes on this chart when the UK economy has been thrown into turmoil and there have been serious concerns about what's going on. And if we start off by looking at the far right-hand side of this chart, which is looking at the current volatility, you can see that it's been recorded at a level of 93.9, which represents a significant amount of volatility and is actually one of the highest points at any time over the past 9 years. In fact, the only times when the UK pound has been more volatile was back in 2022 during the Liz Truss Prime Minister period, the COVID period back in 2020 and the time of the Brexit vote back in 2016. This chart shows the movement in the yield on UK government 30-year bonds over the last 25 years. And as you can see, the current yield is the highest that's been paid at any time in the last 25 years. And the reason for this is because bond prices have been falling as a result of fund managers selling out of UK government bonds. They're exiting from those holdings. And as we've discussed in previous videos, because there's a fixed coupon on these bonds, there's an inverse relationship between the price and the yield. So as demand for those bonds falls and the price goes down, the yield goes up. And the reason why this is important is because the yield represents the price that the UK government is paying for its debt. So the price of UK government debt is currently the highest at any time in the last 25 years. And that represents a significant problem because the current UK government is looking to borrow heavily in order to fund all of its spending plans. And that means that the cost of that borrowing is going to rise, and that's going to put even further pressure on the UK economy. This chart compares the movement in the exchange rate between the British pound and the US dollar and the value of the FTSE 250 index. The FTSE 250 is basically the largest 250 companies that are listed in the UK. The dark red line shows the movement in the sterling versus dollar exchange rate, and the lighter red line shows the movement in the FTSE 250 share index. And what you can see here is there is a very close relationship between what's happening with the exchange rate for the pound and what's happening to the value of the 250 share index. And I think that's quite interesting because in certain circumstances, if the value of your currency goes down, it might make those shares more attractive because the price becomes cheaper for overseas investors. However, what we're seeing here is that overseas investors are not attracted into UK stocks at times when the pound goes down. And the reason for that is because the value of the pound is closely related to what's happening in the UK economy. So if the value of the pound is falling, it tells investors that the economy is also in decline and therefore they're more likely to pull out of the market and not buy more stocks. And if you look at the trend of both of these lines since October, it's significantly downward and they've both moved into negative territory. And that's raising concerns amongst investors around the world. And that's one of the reasons why the FTSE 250 is not doing well at the moment, whilst other stock market indexes around the world are doing quite well. So what's the summary and conclusion today? Well, I wanted to post this video because it's important to stay on top of the data. And we're seeing lots of data coming out about the UK right now. And the retail sales figures for December are a really important metric because it tells us what consumers in the UK are doing. And as I mentioned at the start of today's video, December is the key trading period for most retailers in the UK because it covers that vital Christmas time when lots of people spend lots of money. And what we've seen is that in Christmas 2024, it was a very disappointing outcome for the UK. Retail sales fell by 0.3%, and that was against an expectation of an increase. And when you exclude fuel sales, it actually fell by 0.6%. That is a disaster at a time when the UK needs to be boosting its economy. We've looked at the GDP figures for November, and they show that there was a small amount of growth, 0.1%, which was around half what the market was expecting. And that came off the back of falls in GDP in both September and October. And there is a real question mark now as to whether or not the UK GDP figure for the final quarter of 2024 will be in positive territory. The previous quarter saw a flatlining, and if we see a decline, then the UK could be sitting on the verge of a recession. And all of this is really bad news because the value of the pound is continuing to fall in the international markets. That's having a detrimental impact on the stock markets, but it's also having a really detrimental impact on debt prices. And we've seen that the yield on UK government gilts is now at its highest level for more than 25 years, since 1998. And that is seriously bad news for the current UK government, because their plan is dependent on borrowing more money to fund all of their spending. And the cost of that is going up on a daily basis because the yield equates to the price that they have to pay. And that's going to put even more pressure onto the public finances. And we could see a really vicious circle starting to form here, where we have falling GDP, rising debt costs, people spend less, so we have falling retail sales. The UK is a net importer, so it's paying more for its imports than it's receiving for its exports, so it needs its own people to be boosting its own economy. That's not happening at the moment. And as it sits right now, the signs for 2025 are all looking very bad for the UK economy, and there are major concerns as to whether or not they will be able to achieve any growth in the next 3 to 6 months. So hopefully you've enjoyed today's video, you found it useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.